I'm super excited to introduce Total Financial's President and CEO, Diana Greenberg. Diana?
Thank you, Scott, and thank you everybody for being on this call today. This is one of the most unique things that's happened in a very long time, which, I'll probably bring up a couple times during this conversation, but let me start by introducing the three very distinguished gentlemen that we have on this call today. I'd first like to introduce Brooks Tingle. Brooks is the president and CEO of John Hancock Insurance. I would also like to introduce Stevan Cohen, who is the National Sales Manager of Life Distribution Brokerage at Lincoln Financial. And I would like to introduce Matt Riebel, who is Chief Distribution Officer. All of these people work in primarily the life section, oriented everything about that. And I and Total Financial and Scott are very, very close partners with all three of these companies. We are very, very honored to have you all here, and thank you for taking the time to be on this call.
Our pleasure.
Thank you.
You're welcome. Scott, I wanted to kick this off just really briefly before you start going in, because I know you have a barrage of questions that you're going to be asking, and I know there are a lot of people that want to ask it. So I'm just going to give a little bit of my observation of what's happened throughout the year. I spent a lot of time this morning thinking about it, and I came up with 4 words. They are observe, participate, challenge, and transform. And that's what I do at 4 o'clock in the morning. And I really realized that they were all very pertinent to what's gone on, because we've spent a lot of time observing what's been happening in our industry with the changes. And those changes have gone from everything from underwriting that's been changed because we now have accelerated underwriting with less requirements. We had COVID. We had every company change processing. We went from the 70th century to the 20th century and how to get business in. So there was a lot of changes in underwriting and new business and processing. There was also a lot of changes in product. There were a few companies that decided to get out of the GUL, the guaranteed product market. And then there were some companies that decided to stay in, but there were quite a few number of companies that decided to get out of that space. What I also noticed was, we had AG 49, and then, towards the last end of the year, I started seeing a lot of changes in the indexes and the caps and the rates. And, all of this was happening while we were all going through a political scenario that was either good or bad, depending upon how you look at it. But, our whole economic scenario changed. I also noticed that we started seeing at the end of the year a lot of SUL cases, which meant, as a result of what was going on politically, in my opinion, there were being more people that were concerned or starting to take note of their estates and starting to revisit that and make changes in their estates and changing their products. And I also started seeing variable pop up a lot. And at the same time, this was really big. We saw an extreme difference of submissions. We went the whole year from term on the small case amounts to very, very, very large estate planning cases. So pretty much the middle market in the US for us, in my opinion, kind of got a little bit paralyzed and really didn't really know what they wanted to do or wasn't going to do anything. Yet they wanted to get into it with the term, or, the people that are wealthy did something with their estate. So I saw a lot of that as far as changes. We participated in a lot of this. We were asked to speak to a lot of companies about giving our opinion on how to make changes in new business and processing, and how to sell to our brokers and how to communicate to our brokers. So that was a big focus for Total Financial. Challenge was to all of us. How are we going to exceed during this period of time? Whether you are a broker or an insurance carrier or us, how are we all going to get through this and what did next year look like? And I can say, I'm happy to say that, we got through it with a lot of changes. And I think the three carriers specifically that are on this call definitely got through it. And then we have the transformation, which we are continuing to go through. There has been a lot of changes. And for next year, there's going to, in my opinion, be even more. So we're going to touch on that. So, COVID is a bad thing, and it was for many people, and for anybody that's been affected by this, my, sincere heartfelt concern and love goes out to you if you've been affected by this and your family. But we do see a lot of positive things that have come out of it, and this call is one of them, because we have never been able to put on a call like this with the heads of companies and do this virtually like we're doing today. So this is a big change, and you're going to see a lot more of that. So that's just a few of my views on what's happened. Scott, I'm going to let you take it away, and feel free, go into it, and have everybody else give their comments.
All right, now for the fun part. All right, so here's the deal. We're going to break this up into two sections. The first section is going to be more of a industry related kind of macro look. And then we're going to allow each of these guys to talk a little bit about their companies and where they're going and so forth. And we could be more excited because we've got, with John Hancock, Protective, and Lincoln, three of the best carriers out there that really understand the marketplaces have different value offers for you as well. So the first question I'm going to start with is with Brooks at John Hancock. Brooks, I have interest rates are low right now, right? And they're going to continue to be low. And from an industry standpoint and a product standpoint, how does that affect you guys? And then what should a producer be thinking about when in these low interest rates? Where's the value that they can provide for their clients there?
Well, thanks, Scott, and Diana and Scott both. Thanks so much for having me here. Our relationship with Total Financial is just incredibly important to us, and frankly, just enjoyable on both a professional and a personal level. So it's a real honor to be here with everyone today. Boy, I really, Diana's comments about being optimistic and looking at the positive really resonated with me. And then you started with a question on low interest rates. I'm not sure how to spin that one as a positive, but the most everything else, I think we can find positive in. Low interest rates are unquestionably, and I feel like we need a new word other than low. Chronically low, extremely low. It's there's no sugar. I'm an optimist by nature. But there's no sugarcoating the fact that low interest rates are very tough on our industry. And you've seen that. I'll say, just parenthetically, for Hancock being owned by a Canadian parent, those of you that have worked with Hancock or observed Hancock know that we kind of took our low interest rate medicine 10 or 12 years ago, coming out of the financial crisis, and sort of repositioned our portfolio in a way. Under Canadian accounting, you basically have to do mark to market and assume these low interest rates never change. So we did a lot of the things back then. So we haven't had to take dramatic actions during this stretch, thankfully. But they're tough. So what does it mean? First of all, one of the things we'll be watching is does the yield, not just interest. It's not just that interest rates have been low, but the yield curve has been pretty flat, right? So hopefully the yield curve will start to normalize. We obviously tend to invest in long duration assets. So it'd be nice for the yield curve to develop a more normal characteristic in that regard. Nothing's ever, our business is funny, right? It wouldn't be healthy if interest rates just shot up tomorrow. We need a nice orderly return to sort of more normalized interest rates. I would say at this point, though, it would be imprudent for us to count on it. It would be imprudent for an advisor to hold off and wait because, interest rates will be, higher next year and products will be different or carriers will do different things. We've been just assuming, we don't even sit around and talk. We used to, I think probably in the 2000s, say, what will we do when interest rates go up? We don't have those discussions right now. We just assume this is the new norm and design products to reflect that. And I think, every one of the carriers on this call has done a good job of maintaining, creating, innovating products that still deliver exceptional value. Will you see some trends maybe towards variable? You hear some talk about variable being more prominent, perhaps, things like that. But I think low interest rates are here to stay. The industry can and will weather it. We're all financially strong. We're going to continue to innovate. We've done some things with things like Vitality and so forth to try to bring different forms of value to the customer in the face of the challenges of low rates. But every other answer, I promise I'll be extremely optimistic about.
That's funny. Matt or Steve, either of you two want to jump in and comment?
Yeah, I'll jump in. And let me also thank you, Scott and Diana, for this opportunity. And I echo Brooks's sentiments. We have a great partnership with Total Financial for decades, and we really appreciate this opportunity. Brooks said it very well. You know, the industry is challenged to ensure that we put value on the market for our agents to be able to, represent our portfolio. And I think as an industry, and especially the three carriers on this call, we've done a good job of being creative, being responsible, and to develop products that, are here for the long term. And, I think we're blessed. We have a very diversified portfolio, which allows us to be able to bring, a creative approach to the fund lineup, that portfolio lineup we have. So, I absolutely agree with Brooks. And, I would tell you that the industry is strong in that regard. And I really also appreciate what he said about it's going to be a little lower for longer, right? And products are priced appropriately, and there's some really good value there. Matt?
Yeah, so I've been involved in these kinds of panel discussions for many years. And one thing I've learned is don't be the last person to go on the particular question. Because once you get to the end, it's like, okay. So I won't repeat what Brooks and Stevan already described. They covered it really well. I will take the opportunity, though, just to express my appreciation, the detectives' appreciation to Diana, to Scott, to all the folks at Total for our ongoing partnership, for this particular opportunity today, and for all the people on this call. We know how it works, and I think I speak for all of us. You have all kinds of options of folks you can do your business with, and the fact that pretty darn often you choose to do business with us, boy, we wake up every day striving to be able to have you make that choice. So, I want to start off just by saying thank you again to everybody at Total and to the folks who are doing business with today. Thank you very much.
Appreciate that, man. I think Diana has a comment.
Yeah, I just wanted to summarize that, because it's really important that everybody know, and you guys all said thank you, and you're all on this together, but it is very important that you all know that we appreciate the fact that you guys have had probably some of the most stable platforms of products throughout this year. And when Scott originally first asked about this question about interest rate changes, we discussed many carriers, and we have to applaud you, because just like Matt just brought up, and, Matt, Protective, I consider you, the protection company. You guys have always very priced conservatively, and, you haven't moved, you haven't changed. And yeah. I think that's all true for all three of you, and that's something that we can count on. And I hope that moving forward, for next year, we'll be able to continue to do the same thing.
Thanks, Dan. We strive to be the boringest company there is, because that has been a good thing in times like this.
That's
I actually think you, rather than see a retrenchment, the tendency during quote unquote tough times, global pandemic, low interest rates, is to retrench. We kind of take a different view of it at Hancock. We think it's a great time to be on offense. Americans are more aware of their own mortality. Unfortunately, it took a global pandemic to make it such, but we see a lot of growth opportunity next year. So we're kind of leaning into it, and hopefully you'll see that our competitive position actually improves, not erodes.
Actually, that's a really good lead into my next question, because I like the way you said, we want to lean into it, make investment. So we just went through kind of a polarizing little event in the last couple of months with, the change in leadership in the country and so forth. And I don't want to make this a political conversation. What I want to do, though, is talk about opportunity. There could be some, opportunities and some changes in legislation and regulation coming down the pipe. Obviously, we have AG 49A that just happened. but I do think there's some opportunities. And Steven, I'm going to start with you here. Where do you see some opportunities given that change in leadership and legislation and so forth?
Well, I do appreciate the political question, Scott, put me on the hot seat. So thank you for that. But I won't go anywhere near, I won't go to that end of the spectrum on this. But look, we, all the carriers in the industry, we look very, very closely at what's happening, in Washington, and especially with the change in leadership that'll happen in January. There's absolutely going to be change, but there's going to be real opportunity. And I applaud Brooks for his comments about, how we feel as an industry. Let's look at the first topic that comes to mind at taxes, right? And I think we all would agree on this line that both the individual tax rate as well as the corporate tax rate is going to be going up. And that's just a reality of the need to bring revenue into, the federal coffers, if you will. Life insurance is uniquely positioned right now to bring value in that non-reportable income space. Many of you on the line would think about it as supplemental retirement planning. And when you look at the portfolios that are out there, whether it's a index universal life accumulation product or a variable universal life accumulation product like Lincoln has with Asset Edge, clearly there's a huge opportunity there. I think you opened up the comments, Scott, around wealth transfer and estate taxes. I believe that they're going to be looking at reducing that exclusion. I'm not saying it's going to be back to the 90s when it was 600,000, but I'd be very surprised if you don't see that the annual exclusion being reduced. And that's going to be a unique opportunity for us. There is no more effective wealth transfer asset out there than a life insurance policy if properly structured. So really bullish on that. And I think Lincoln is well positioned. If you read the Democratic platform, there is some language in there around the fiduciary standard and business and the best interest rule. So we're going to keep an eye on that. That would impact manufacturers and distributors of financial products. And obviously it would impact financial advisors and financial professionals out there. And then lastly, because I want to leave time for others to comment, you mentioned AG 49A, and I think we're going to see a residual impact to AG 49A come the first part of next year, as carriers now try to recalibrate their positioning in the marketplace with their index universal life options. So I think you'll see a little bit of that. And then lastly, on the state level, there was an interesting development in the state of Washington, and I don't know if the panelists have seen this, but what I believe is the first time is a public option for long-term care coverage that the state of Washington just rolled out. And, that's going to go into effect in 2022. So for those of us on the line that represent long-term care solutions, I think the industry is well positioned there, and Lincoln, obviously, with our MoneyGuard linked benefit product as well as our long-term care riders, we're very well positioned there. So just high level, Scott, I'll summarize. We're bullish. We should feel really good as an industry, and there's some really, really competitive products out there that our agents and advisors can leverage.
I'm going to sneak a question in this came in from one of our attendees. And actually, Diana kind of brought it up, and I'll call it. We missed out on that singles and doubles in the middle, but this question actually is really good. Talking about survivorship plans, are you guys going to update and bring back Survivor? Because we've got down to very few Survivor products. I mean, Brooks, your product is still very competitive, but there's very few of them left in the marketplace. Are we going to see an explosion there in pricing and underwriting and product development? And that could be for any one of you guys.
Should I jump in?
Sure, go ahead.
Yeah, I'll jump in. From a Lincoln perspective, we have a very competitive variable survivorship called Survivorship VUL1, and we've driven significant business through the years on that. We also are looking to potentially bring back a survivorship index universal life product. We're currently looking at that. So I would imagine you will see a lot of activity in the product development side. There's no doubt that estate planning and wealth transfer is going to be on most carriers' radar this year.
Yeah, thanks, Steven. We never really stopped thinking this space was great. Obviously, there were fewer states, I guess, where it became relevant here under the recent laws, but we're very, very committed to the space. SIUL, VUL. you can count on to stay very competitive there and continue to innovate there.
What about you guys, Matt? You guys kind of pulled back a little bit on Survivor. Are you guys kind of looking there again, or where's your thoughts there?
Yeah, there's no doubt there are opportunities there on a go forward basis. And you said it exactly right. I mean, that is, I think all of us have to pick the places that we want to play, and that's one of those places that we said we're not going to play in that survivorship marketplace. But we're always looking at, so how are things changing? Are the opportunities a little bit different? Do we feel differently about those markets? But there's nothing, you're not going to see us roll out a survivorship product next year.
Okay, that's fair. All right, Matt, this one's for you. So 2020 obviously was an interesting year with COVID. And we could sit back and go on this pandemic and go backwards and go how many negative things happened. But you know what? And Diana and I both believe this, that there is some positive that happened in there, especially with some of the insurance companies moving forward. So talk about from your perspective where you saw some positives.
Yeah, that's a good question. I appreciate the opportunity to touch on that. So, look, we all know if we had our druthers, we'd rather that this pandemic didn't take place, and I think Diana touched on that point really well. But oddly enough, there were some good, positive things that came out of it. And I know the question was really, one, if you indulge me a little bit, I'll really touch on two different things. The first thing is, it's interesting too how this happened. It's not like we knew it was going to happen and we all had a ton of time to prepare for it. I mean, it just happened, and it happened fast, and we all had to respond very quickly. So one of the things that happened when we woke up, and we it felt like in a day, we went from we were working with people face to face, and then all of a sudden we were almost 100% virtual. So one of the things, really positive things that took place was so many of you leveraged our electronic capabilities. And I'll give some specific examples, the experiences that we've had at Protective Life. I will point out, I'm gonna give you three different stats here. The relevance of each of these things, in each case, each of these things makes it easier for your customers, easier for you, and by the way, it gets you paid faster, and all those things are good things. So let me start off with electronic applications. Electronic applications for us so far this year are up 27%. And I'll touch on not just the stat, but I'll give you a little deeper information on the relevance to the folks on this call. When folks use our Easy App platform, reduce cycle times up to 14 days. So, and I'm talking cycle time, submission to commission. So that's a pretty significant improvement. Voice signatures were also up. Voice signatures so far this year up for us 68%. And again, relevance there is that saves 5 days in cycle times. And then electronic policy delivery, this is the biggest number. Folks who are using electronic policy delivery up 122%. So far this year, and again, relevance to you and your customers. It's interesting, there's a multiplying effect that takes place. So when folks use EPD with us and they use voice signature, it actually saves 14 days combined in cycle time. So there's no doubt about it. One of the big things, positive things that came out of this is all of you leveraging and using our electronic capabilities. And again, I think that's across the industry. It's not unique to Protective. So that's one. The other thing I'll point out, and again, if we all had a choice, we would definitely prefer that this had not happened. But there's no doubt about this pandemic reemphasized the need for life insurance just across the board. Everybody became way more attuned to the fact that we are mortal. And the latest number of stats tell us that only 54% of Americans own life insurance. But interestingly enough, and again, this is the research from this year, 36% of those folks intend to buy life insurance in the next 12 months. So again, horrible situation that we've all been here, but it definitely has re-emphasized the need for life insurance. So I think that the combination of all the leveraging the electronic capabilities, and then again this re-emphasis in the need for life insurance. Those are two things that fall into the positive category as results or impacts from the pandemic.
I would just add, I totally agree, Matt. The innovation that this has necessitated and accelerated around underwriting innovation is just great. Use of electronic health records is something Hancock's really tried to embrace, to not require people in the middle of a global pandemic to have welcome a paramedical examiner into their home or whatever. But just one thing I think everyone on this call should really take pride in is how our industry is there for people at times like this. I look at, we try to look at claims not as like claim numbers, but I actually try to look at the people behind them. And I've looked at all of our COVID claims. It's going to sound weird for the leader of an insurance company to say, but sadly, we haven't had very many of them. Like, to me, it may sound weird for a leader to say, gee, I wish we were paying more claims, but it saddens me, the fact that the vast majority of these people dying from COVID don't have life insurance. But of those that do, everyone here should be so proud to have provided those solutions to people. We've paid claims, COVID claims, to people that have been policyholders for 94 years. Policy where parents got the kid a policy when he was born, died from 94 from COVID. But we paid COVID claims as young as a 29-year-old, and so it's affecting a lot of people. And imagine getting COVID, getting that ill, sort of thinking, okay, I may not survive this, and to think I don't have life insurance too. So it just really affirms the critical work you're all doing, and it also sort of confirms the work we have to do as an industry to reach every American that can possibly afford it. Unfortunately, a lot of Americans can't, but those that possibly can, to have them benefit from our solutions, because it really comes to the fore during events like this. We saw it after 9/11. You see it here, these unexpected events. People say, wow, life insurance. That's why people have life insurance. And
Wow. Well said. Right to the essence of our industry right there.
And Scott, if I could add just another different perspective here, and I agree with everything Matt and Brooke said. We've also seen a high utilization of our lab-free and our straight through processes. But there's another aspect to this that we've seen some real value, and that is our ability to communicate and bring value over a medium like this with our wholesalers, and then with our marketing structure and our focus. We've totally digitalized our marketing strategy within the walls of Lincoln. And now agents, advisors, our agencies can come on and really have a very seamless, very effective experience with multiple landing pages and value add content. So I think that's also been a real positive as a result of COVID, is just changing the trajectory, if you will, of how we deliver value to our customers. And that's been a real plus. And I'm sure not just for Lincoln, but for all the carriers out there.
Yeah.
Well, across the board, I mean, we've added Zoom, we've added different ways, we've added video emails, a lot of different things that we've done too that has helped. I know Diana wanted to kind of add on to some of the positive pieces of this, so I'm gonna let her jump in here too.
Actually, this is going to be, one of those challenging questions or answers that I'm going to give, because this is my area that you all know that I'm very passionate about. All of you already were on a digital platform, as you've mentioned. We started down this road a few years ago, and just some companies had to up it faster than others, and some companies had to get in it for the first time, period. I think, moving forward, most of the people on this phone call will probably agree with me. What is going to be the challenge is that every company pretty much has a different way of submitting business. And for the agent, it becomes a little bit challenging to figure out how I'm doing it with this company and how I'm doing it with this company. And it's, when I said participation, which is something I like to do and work with all of you and your different companies, it's a goal to be able to get a general platform of what you all are asking and needing to be able to go through this process and qualify for this accelerated underwriting program. So I think that's something that we will continue to work on next year. And I think that right now you are all right on the straight path of going in that direction. And as far as Steven, I couldn't say it 10 times more than you did. We have changed the way we communicate. This is how we are going to communicate. This is how you will receive marketing materials. This is how we will communicate with our agents, our carriers. And you know what? How you should be communicating with your clients. And if you're not communicating with your clients, you're really missing that opportunity, because now more than ever is the time that you should be reaching out to your clients, because they need to know you care. And whether you're selling insurance or not, they need to know you care. So that's just the one thing I wanted to add.
Diane, if you don't mind, I want to add one thing there. It's kind of interesting because you were talking about how we've all leveraged technology in different ways, and we're engaging in completely different ways. And it's kind of interesting. I think I hear people sometimes saying, well, I can't wait till things get back to normal so I can go back to doing what I was doing before. It's like, oh, wait a minute. I mean, we all got so good and we learned so much in this time period. And I know, and again, I'm sure, Steven and Brooks are going to say the same thing, but we have this incredible opportunity once we get on the other side of this thing to say, look, we got really good at this, and we're going to continue to utilize that because it will make us all more effective and more efficient. So again, I think it's just something to think about once we get beyond it. Let's don't just put this stuff to the side. Let's use that to make us all better going forward.
And Matt, I totally agree. And that doesn't just apply to like how we work together in marketing materials. It applies to like underwriting practices in particular. I'm so determined to make sure, there are a bunch of things that have been done sort of out of necessity. They were sort of on an arc of where we were all heading anyways, right? Digital and electronic health records and things like that, use of analytics, but COVID made them a necessity. And I'm determined to make sure that when this ultimately fades away, hopefully before too long into next year, we as an industry don't say, oh, now we need to go back to having you have that paramed come to your house and go for that insurance exam. We cannot do that. And I'm sure the three of us, at least on this call, will commit to not doing that, because we have to keep moving forward. We have to accelerate it, not go backwards after this.
Fully agreed. I have one last industry question that I want to ask, and then I want to leave especially time so you guys can talk about each of your individual carriers too. But over the last 2 years, guys, and this is tough. There's been a lot of carriers making changes, right? There's big names. Trans just came out and said they're going to leave the LTC space. Met split up. AXA turned into Equitable again. AG's got things going on. There's definitely, I would assume, going to be a flight to quality going here, but there's a global effect on the producers. And really, at the end of the day, how should our producers view that, and where should they go for that? And I'll leave that up to you guys to choose who wants to start on that one.
I'll start, if that's all right. It kind of dovetails into the conversation we just got finished with, right? And you said it very well, Scott. I believe it's going to be a flight to value over price, and understanding exactly, what is that experience and what is an agent selling and who are they representing? And losing competitors is not a positive thing for anyone on this call. That drives us, to keep sharp, to make our pricing as effective and as impactful as possible. So, I truly believe that, agents should be looking at the post, the pre, and the during experience of underwriting these cases and putting these risks on the books for their clients. And what does that look like to them as an agent and to the client once that policy is actually in force? And going towards those quality companies that are here for the long run, and really changing the perspective of it's not just price. And I think that, this has helped us in this COVID world to really look at all these platforms that are coming out there, and how do you put these policies in effect efficiently. And so I really think it is a flight to quality. And I know Lincoln is well positioned for that, as I'm sure the other carriers are. But Brooks, I didn't want to interrupt you, so I'll throw it to you.
Oh, no, not at all. Thanks, Steven. And yeah, I think there's still a good stable of companies that are very committed to the space. And I can tell you at Hancock, as mentioned it earlier, but we're leaning into this. I see more opportunity than I see peril. Again, because we're owned by a Canadian parent, we had to kind of take a bunch of tough actions 10, 12 years ago. We are all in on this market now. Our parent company is giving me money to invest. We have a growth plan next year, or a sales plan that represents double-digit growth. And by the way, we're counting on Total Financial to play a big part in that. So, but no, we're leaning into it, and you'll see from things that we do in the coming months that we're not pulling away from this market at all. We're leaning into it, and we're intending to grow. And I know there are others that see it that way. It's a time of unprecedented opportunity in this environment. Yes, challenges of interest rates, but demand has never been higher for our solutions. The need has never been higher. The level of creativity and innovation across both new business and underwriting and in force has never been higher. Digital technology can play a role that it's never played before in terms of efficiency and reaching new customers. So we're all in on the space.
Matt, you want to chime in from protective standpoint on that?
Yeah, first of all, I love Brooks is asking for the business right here on the call. You do it, man. All right. I love it. That's good stuff.
If you don't ask, you don't get, right?
That's right. I'll maybe go at this a little bit in a little different way, but look, there's no doubt about it. Like when companies bail out of markets or they pull products, look, that's always, it's hard. It's hard for everybody involved. But the thing that, and again, I think I'm like maybe many people on this call. This is my 32nd year in the financial services industry, so I've had the value of a long time watching these things happen. And the thing that strikes me about every time we go through one of these cycles is it's a great demonstration of the resiliency of the life insurance industry. Because I'm telling you, if you go back, pick your number, 25 years ago, 20 years ago, and if you look at all the companies who were writing particular products who don't write them today, who were in markets who aren't in those markets today, some of those companies aren't even in business today. And then look at where we are today. It's like, I'm telling you, all that stuff happens and it's bad, but we just keep on going. So I'm just really impressed by the resiliency of the life insurance business. And this is, again, when these kind of things happen, that's a great demonstration of that.
All right. I do have one question. I'm going to ask that one in a little bit, but I want to get into each of the individual carriers. And Brooks, I had a two-part question for you, but you've really kind of answered part of it about the stability of John Hancock. I kind of want to now focus on Diana's favorite topic, which is vitality and aspire. It's definitely one of the innovations that's different than everybody else in the industry, right? You're looking for, to help make people healthier. What was kind of some of the thought process behind that, and kind of give the pitch to the producer why they need to be thinking about that and adding that to their practice?
Sure. About 5 years ago, maybe it was 6 years ago now, I sort of woke up and realized that we were selling a product that no one got any excitement or joy out of owning, and it was incredibly hard to buy. And that didn't seem like a winning formula in the modern digital economy, to be selling something that people don't get excited about owning and is really hard to buy. So we set about to change that and said, let's make owning life insurance about something more than death. And don't get me wrong, we all know the value is there. There's always been the value. We talk about peace of mind, but peace of mind is kind of a double-edged sword when you really think about it, right? Like, it's nice to know that if I get hit by a snowplow later here and die, that my kids will get to go to school and all that, and their mother can have a big party and all those types of things. But the downside of that story is I'm dead. So peace of mind isn't the happiest sort of feeling. And then you think about interacting with your life insurance company, and what are those interactions every year? You get a bill, you get an annual statement, you get a privacy notice. I mean, that's exciting, right? So we wanted to change what it meant to own life insurance, make it engaging, offer even more value while you're living. We've always offered living benefits as an industry, cash value and the ability to take loans and things like that. But even more value. And it comes in all sorts of forms. Most of you know Vitality. I don't need to do a commercial for it, but those customers are now interacting with their life insurance 30 to 40 times a month when they're getting a discount at the grocery store, or they're spinning the Vitality wheel, or booking a trip, not so many trips on hotels.com this year, but booking those trips, what have you. And I'll tell you what, you know what all of our research says? The customer satisfaction with it is off the charts. But you know who they're satisfied with? They're satisfied with the advisor that sold it to them. When they're in the grocery store and get a 25% discount, I promise you they're not thinking about me or our corporate headquarters. They're thinking about the person that provided them this solution, the advisor that made this recommendation. When they get the discounted hotel stay, again, they're not thinking about, you know, fathead me up in Boston. They're thinking about the advisor that gave them the solution. And we have all sorts of data I won't bore you with now about increased referrals. These policies are more likely to place. But I would just say, in terms of being on the right side of history, you think about what we've learned through this pandemic. People are more aware of their own mortality. They're also more aware of the importance of baseline health. One of our reinsurers did a study that asked U.S. consumers, what's one thing you'll do differently as a result of COVID-19? 70% of people said exercise more and lose weight, which I was kind of blown away by, but it makes sense, right? If you look at COVID outcomes, your baseline health before you get it matters a ton. So we think life insurance that provides that protection, you know, at the time of death, but all this value while you're alive, help you live a longer, healthier life. We think it's the right solution for this time in history. So I wouldn't say we've checked the box yet in terms of making insurance fun and engaging to own, but we're well on the way with Vitality and Aspire. Now we've turned our attention full bore to making it easier to buy, because it needs to be both. And we can't have this fun digital thing to own, but then sell it this old-fashioned way. I've said this 1,000 times. People have heard me say it before. I really think life insurance is the most difficult product to buy in the modern economy. I joke that a home is difficult, but your realtor doesn't ask you for your blood and urine, or at least they shouldn't. And we still do those things. It's nuts, right? It couldn't be more invasive. It couldn't be more lengthy. Thank goodness we have you guys to shepherd people through it, or we'd sell nothing. But we have to make it easier for you too. So all of the innovation and partnerships with wonderful companies like Apple and Amazon and these companies that we've done to change the in-force experience, the ownership experience, we're now bringing to bear to try to change the underwriting process as well, and more to come on that.
So Brooks, you all three have different ways that are focused on people improving their health during the lifetime of their policy, and or being a major concern about what my health is going to be down the road. And especially during this time where we have COVID, right? I'm finding that I'm getting asked more and more by people who are obviously very worried. You know, they want long-term care. They're really concerned. They have to have it. So, you know, this hits all of you, as Steven's sitting here, like, you know, nodding his head, going, yeah, he's seeing that. I'm sure, and you hit it. You started it. So I'm just going to let you finish this. I'm sure you are going to be seeing an uptake in your Vitality and the people that are using it, like the 82-year-old that I just got issued that's already at platinum in 4 months. That's crazy, right? But there are more people that are doing things to be healthy. So have you seen an increase in that?
First of all, I love that story, but I'm embarrassed that she did it like 7.5 months faster than I got to platinum. So, but anyways, yeah, and there are all sorts of myths like that about Vitality. Well, older people don't value it, and they do, right? I mean, that's amazing. She did that in 4 months. Wealthy people don't value it. I've got story. One of my favorites is I was getting this email. I don't know if it was one of your clients or not, Diana, but I was getting this email from a guy saying, hey, I'm so excited to get my free Apple Watch through Vitality. If I give you my FedEx account number, can you overnight it to me rather than have it shipped from Apple? And he was hounding me. And I finally asked Susan Galili, our chief underwriter, like, what can you tell me about this guy? What's his story? And it turns out his net worth is $155 million, or a commercial real estate developer, actually in California. And but he was desperate to get his free Apple Watch. He could obviously go out and buy an Apple Watch. So it's a crazy phenomenon. But yes, absolutely, much more interest. While sales overall this year have been a bit of a challenge, we've held up better than most, but have been a bit of a challenge. Our Vitality sales are way ahead of plan this year. So definitely the right kind of solution for this time, I think.
Yeah, I think that goes. Yeah, I think that goes to that value conversation that I think everyone on this call has said. Yeah, Dinah likes to spin the wheel on Vitality, don't you?
Spin the wheel.
She kind of counts. I am going to switch over to our friends at Lincoln. Stevan, guaranteed products, and we've talked about them, right? They've made some evolutions, I think is a word I'm going to use. And I know you guys have focused more on your VUL platform a little bit and have been really successful with it. A couple of things with that. Number one, how do agents access that, that VUL piece of the business? And especially for on the other side, for those folks that aren't securities licensed, where's the product value, in that change? And then I'm going to throw one third one on the end. And if you want to touch it at the end, with MoneyGuard, you guys have a different position than the other two with long-term care there. Talk about a little bit about that marketplace and where you're going. So it's a pretty large question, but I think this all ties into one.
Well, thank you, Scott. Let me start with the MoneyGuard question first. We are a leader in the linked benefit long-term care space, have been since 1985. We are actually going to be launching a variable design of that product, and that'll come out in February. So when you think about where the industry is going to some degree with the pricing of the products, you're starting to see Lincoln really double down on that variable message, both in our core life insurance offerings, as well as in now the long-term care product. So we're really bullish about that. Your second question around where agents who aren't registered should look for value, I would really passionately ask them to consider getting registered. I think that there's an opportunity for them to, bring a multitude of products that would not be available to their clients if they're not registered. And it's not just Lincoln, but there are other carriers out there that are looking to bring variable portfolios into the marketplace, especially after AG 49A. You're seeing index options rolling onto variable platforms as well. As it relates to how do they access the product if they are registered, I would tell you that probably one of the misunderstood concepts of our business is that traditional agents who have registration with broker dealers, the vast majority of them can do business with firms such as Total Financial. We have thousands of selling agreements at Lincoln, and they range from regional small broker dealers up to the national wirehouses. And there's a consensus out there that they can't do business with third-party BGAs. That's just not accurate. There are broker dealers who are restricted, and we have a list of those, but the vast majority of broker dealers will allow their registered reps to work through a BGA as long as the compensation flows from the manufacturer to their broker dealer, and they follow their requirements and their due diligence. So if there's a message out for the agents who are listening today, pick up the phone, call Total Financial, ask the question, go back to your broker dealer, ask your OSJ, and you may be very pleasantly surprised as to what you can and cannot do as it relates to representing a firm like Lincoln on the variable side. So I know it was quick, Scott, but I want to be respectful of the time.
Yeah, to that point, we are registered. You can do business through us. We actually run through the Leaders Group, and they're great partners of ours. So you can access the great underwriting with Diana's team and so forth on the VUL business. And I think that's the most important piece is most of the time we can, and you get Diana's team on that. Though I want to come back. I do want to come back, and you did tell people to get registered, and I want to push back a little bit because you are going to have agents that they don't want to deal with that. Where do they go for value?
Well, I think they first and foremost they need to educate themselves on what other products that are out there. There is an array of products and carriers who have a diversified portfolio. I'd like to think Lincoln has probably the most diversified portfolio. What's out there right now? Index universal life insurance, clearly for both accumulation and protection. There are carriers. Matt still has, a GUL out there, as does Lincoln and other firms. And then you have, obviously term insurance and your long-term care offerings. So, and of course, whole life for those carriers who offer that solution.
I would just agree with Stevan on IUL. We talk a lot about AG 49. It actually didn't change the real value of IUL, right? AG 49. It changed how we have to illustrate it. The real value hasn't changed.
Right.
Oh, truly agree. It's just changes the way that they illustrate. And frankly, for me, I've cut my teeth for a lot of years with a background in IUL. I actually like it. It kind of brings some normalness back to the IUL space. I think, Steve, teed up Matt pretty good right here on the guaranteed side. Protective has been super consistent on your protection focused products. You're still doing the long-term guarantees, Matt. Matter of fact, during this pandemic, you came out with a good old-fashioned term for life GUL that was relatively competitive. How's Protective able to do that? Number one. Number two is, do you have any product changes coming down the pipe? And then three, you and I kind of touched it back and forth. Do you have some activity going on the M&A side? So kind of a large question for you.
Sure. So yeah, I appreciate that. Going back to long-term guarantee products. So there are a lot of things here. I mean, and one of the most important things is, I mean, years ago, we planted our flag as a protection company, and I often joke, it's like, with a name like Protective, I mean, what choice do you have? You got to be a protection company. I mean, that's a joke, and certainly if we didn't, we would be missing a leverage point on our name. But very seriously, we've been at it for a long time. We're clearly committed to it. And this year, as you alluded to, I mean, we just doubled down on our commitment to being a protection company. And as we've all seen, there were just a lot of companies who are significantly limiting their products or pulling their products in the long-term guarantee space. And we just went exactly the other direction. I have this image in my mind of that, where there's a disaster, an emergency, and there are just people running away from that. And then you have some people running to that to help the cause. And that's how we were. So in the middle of all those things going the other direction, we launched our lifetime insurance GUL product, as you alluded, and it's just thanks to the folks on this call, and we're doing exceptionally well with that product. Had huge momentum, and in addition to that, we also, in that same vein of long-term protection, we launched a 35 and 40-year term option at the same time. We rolled out the lifetime insurance product. So we're doing that for a few reasons. I alluded to it before, but we none of us can do everything. We can't be all things to all people. We all have to pick our spots and say, where are we going to play? And we're just really, really good at those protection products. So we want to play to our strengths. I'll tell you a little stat, and this might be surprising to some folks on the call, but we have almost $1 trillion now in face amount coverage, 979 billion to be exact. I think we're actually, that's the latest number. I think we're actually tipped over the $1 trillion number now. But and we want to do as much protection business as we can, which again is very different than a lot of other companies. So back to one of the core questions you're asking there, Scott, is like, so how are we able to do that? And we're able to do that because it's for a bunch of different reasons, but because we build and we price our products based upon what I just described as the current realities. And I'll give you an example. What I'm talking about, as an example, we don't use what's called, and I'm going to get a little bit geeky here, but it makes the point. We don't use what's called reversion to the mean pricing approaches or strategy. And what those reversion to the mean pricing strategies say is like, yeah, interest rates are really low, but on average they're up here. So we're going to price and we're going to build our products assuming that eventually they're going to get back to that. And so that's okay if it works out that way, but if it doesn't do what you assumed is going to happen. That's when you get all kinds of problems. You get products that don't perform the way folks thought they were. We're pulling products, we're getting out of markets, and more broadly, this overall strategy that we have is reflected in the fact that we've never raised COIs in the history of our company. So there's a broad perspective on this thing, but it goes back to one of those elements is that getting price and we build our products based upon what is really happening, not what we think or what we hope is going to happen in the future. So again, we doubled down on this. We're good at it. We want to do as much as we possibly can. We focus our energy on being that really, really strong in the protection space. And back to the final question you asked on that, Scott, are we looking to make any changes? And the answer is no. We got a good thing going here. We have an opportunity because we're performing at a high level, but because we have a lot of people who decided that they didn't want to be in that marketplace. So we're going to do everything we can to keep that going. So related to your question about M&A, look, I mean, the broad question was, do we feel like there's going to be more acquisitions in the industry? And you guys, and I'm not saying anything in particular about us. Everybody knows, look, we're big in the acquisition business. We look at it as our unfair advantage because we have multiple ways that we can grow. So we're always, it's not like we're ever out of the acquisition business, but just watching the things that are going on in the industry, people were a little bit hamstrung during the pandemic for a whole variety of reasons. But I think what you'll see is once we start to come out of this, you'll see some activity taking place. So yeah, I think the short answer is, yeah, the movement's going to start to increase going into next year.
Perfect. Well, we are coming to the end of the hour. And I have one quick question for each of you, because I think this is really at the end of the day where the rubber meets the road. If each of you had one opportunity zone for an agent to say, yes, you have valuable time, valuable resources, and limited, where would you put them? So Matt, I'm going to start with you, and then we'll go to Steven, and then we'll end up with Brooks on that one.
Yeah, so I'll be real brief. I mean, lots of times when you ask this question, it's kind of like, what markets, what products, that kind of thing. I'm actually going to go back to some of the things I was talking about at the very beginning. If it was me, I'm looking at the ways that I can grow and improve in 2021. I'd say just leverage the heck out of technology, and in two major ways. Leverage technology in ways that you can engage with your customers, and then use every bit of carrier technology you can get your hands on, because again, when it's all said and done, it makes it faster, easier, less expensive. And by the way, I mean, as carriers, we invest literally millions and millions of dollars on our technology, and it's free. It's free to everybody who wants to use it. So the big thing I would say is this: leverage the heck out of technology to help grow your businesses.
Steven?
I would echo what Matt just said. Number one is I would learn to leverage the technology and sell off of this medium, because this is the future, and we're seeing agents that are embracing that. And number two, from a Lincoln perspective, we've done considerable investing in what we call the specialty markets area, and there are 4 components to that. We focused on premium financing, foreign national business, business insurance, and a new development, trust-owned life insurance. But I would tell you, if I was going to focus on one particular area, I would look at the business insurance marketplace. I think it's underutilized. I think there's a lot of ability to learn and to leverage that knowledge and work with business owners. So I would focus in that area.
Perfect. Brooks?
Those are great bits of advice. I guess I would respond with a very, very specific opportunity, and that is Americans living with diabetes. There are over 30 million Americans living with diabetes. A few million of them make over $125,000 a year, and most of them think that they can't get life insurance. They're way underrepresented in our sales, and we have a solution in John Hancock Aspire that can save them 25% off their premium, not through any gimmick, through a simple fact, which is when our industry underwrites someone living with diabetes today, we look to see whether it's well controlled or not, and we give them some break on the pricing, but we only get that one bite at the apple, and we don't know whether that person will be controlling their diabetes 5 years from now, 10 years from now, so their price is going to be higher than it should be for someone who does control their diabetes. So the proposition is simple. If you're living with diabetes, you're controlling it well, and you're willing to share with us each year that you continue to control it well, you can get 25% off your life insurance premium, and of course, get life insurance, period. There's only like 400 million of life insurance sales to people living with diabetes a year right now. It should be multi-X that. Wonderful opportunity for producers to grow their businesses, to not just think Aspire when you come across a person living with diabetes, but let's work together to go find them, because that community of folks deserves to be covered, and we can offer them excellent value.
That is amazing. So we definitely went over our hour, but you know what? I feel like honestly we could sit and do this forever because there's so many great questions, and the three of you have been so kind with your time and your answers, and they were true and they were open, and we so appreciate that. So I want to personally thank each one of you. I know Diana, you want to say thank you as well. So I'm going to let Diana say a few words, and then we'll close off the meeting for today.
Yeah, I really want to thank all three of you for your candor and the fact that you were able to do this meeting with us. Like I said in the beginning of this is very unique. This does not happen. I really like what all of you said, and I was about to like reiterate one of my father's favorite thing, which is, you know, a 2-minute elevator pitch. And interesting to see where you all drove about the opportunities. And if you saw my notes in front of my desk, you'd see this big thing that says tech, 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 tech. And, you know, for Total Financial next year and for all of you, we're making major changes. And, you know, it's going to be so much easier to do business. So we're all on the same page about making it easier to do business for agents using technology and doing the sale. But I got to say, one of my biggest focus is that long-term care sale. And I think that if you're not quoting that to your clients and you're not quoting some sort of critical care or long-term care in those illustrations that you're selling, you are missing a big ticket for next year, because that's going to be on everybody's mind. So that's just my 2 cents. You guys, we love our relationship with all of you. We consider you incredible partners. And I just want to thank you from the bottom of my heart for doing this for us and taking care of all of our agents and our clients. You are the best.
Thank you.
Thank
Thanks
you,
for having us.
everyone. Have a wonderful holiday season and stay safe. And thank you.